Alex and the Brewhaven. On another beautiful day at Brewhaven, Alex is thinking about how to properly manage his finances and organize his financial records.
I think I should call Tina again for help. She's the best accountant in town. Beautiful day. Tina, I think I might need your help again with my finances.
Sure, no problem. I am an accountant. You can trust me.
Tin, sorry to meet you here. Coffee?
Nah, don't mind it. I also want some coffee.
I don't know how to manage my financial transactions like you do.
Oh, is that it? Care to elaborate on some of the problems?
Like, I can't even recognize my finances. I don't know how to deal with dollar accounts, how to organize the financial records and all. My records are a mess. Maybe that is the reason why I can't make a better decision for my business.
I agree with that. Remember, behind every successful business is a good accounting system. And I think I need to teach you the accounting concepts and principles first. It is our guiding standard when we are dealing with business transactions.
Ow. Wow. Okay. I am willing to learn about it. So let's call it a date?
A date. I will say yes only if you already mastered your accounting.
Too much? When that will be? Ha ha ha.
Accounting concept and principles. The JAP, or the Generally Accepted Accounting Principles. It is a set of standardized guidelines, rules, and procedures that govern financial accounting and reporting for businesses and other organizations. The general acceptance of an accounting principle usually depends on how well it meets three criteria, namely relevance, objectivity, and feasibility. These are the underlying assumptions and principles. The separate entity concept is the business viewed as a separate person, distinct from its owners. For example, you opened a separate bank account for the business and deposited 250,000 pesos to this account. Your personal transactions record must be separate from your business. Historical cost concept. Assets are initially recorded at their acquisition cost. Just for example, your business acquired a printing machine. The regular selling price is 100,000 pesos. However, you acquire it at a discounted price of 90,000 pesos. Then, you will record the machine at its acquisition cost of 90,000 rather than at the regular selling price. Going concern assumption. The business is assumed to continue to exist for an indefinite period. You don't intend or expect to close your business in the foreseeable time, do you? In this concept, businesses are forever. Again, businesses are forever. That's why we also record transactions like receivables and payables, because we assume that our liabilities will soon be paid and receivables will soon be collected. The opposite of going concern is a liquidating concern. This is the case for the business intends to end its operations or if it has no other choice but to do so. Next is matching. Some costs are initially recognized as assets and charged as expenses only when the related revenue is recognized. Revenue earned must match the expenses incurred. For instance, the business acquired an initial inventory of coffee, vanilla syrup, and milk for a total cost of 50,000 pesos. You will record the cost as an asset rather than as an expense. If in case there is a sale, then there will also be an expense for making that sale. Matching is also called as association of cause and effect. Revenue matches the expenses of the business. Accrual basis of accounting. In accounting, we indeed live in an accrual world, because economic events are recorded in the period in which they occur rather than at the point in time when they affect cash. For example, all the inventory was sold on credits for 300,000 pesos. In Filipino, the inventory is paninda, and sold on credits means pinautang. You will immediately record the credit sales as accounts receivable rather than waiting for them to be collected. In Filipino, receivable is pautang. We have prudence or conservatism. We, accountants, observe some degree of caution when exercising judgments needed in making accounting estimates under conditions of uncertainty. Just for instance, the debtor for the remaining 10,000 pesos is in financial difficulty. Debtor means taong umutang in Filipino. This has raised doubt on whether he can pay his account. You will immediately recognize the doubtful account as an expense, such that if the accountant needs to choose between a potentially unfavorable outcome versus a potentially favorable outcome, the accountant chooses the unfavorable one. This is necessary so that assets or income are not overstated and liabilities or expenses are not understated. Periodicity, accounting period or reporting period concept or time period. Under this concept, the life of the business is divided into a series of reporting periods. The business owner may be right, however, it would be impractical to wait so long to determine the financial performance of a business. Users need timely periodic information to help them make economic decisions. Managers need periodic information on the results of operations for them to properly perform their functions. A reporting period is usually 12 months, although it can be longer or shorter. A 12-month accounting period is either a calendar year period or a fiscal year period. A calendar year period starts on January 1 and ends on December 31 of the same year. A fiscal year period also covers 12 months, but starts on a date other than January 1, for example, July 1, 2019 to June 30, 2020. Next is the stable monetary unit. Here, assets, liabilities, equity, income, and expenses are stated in terms of a common unit of measure. For example, when preparing the financial statements, you discovered that the business has $10. You will translate this to the Philippine peso using the current exchange rate. The amount that you will report in the financial statements is the translated amount. The materiality concept. Materiality is a matter of professional judgment and is based on the size and nature of an item being judged. This concept guides the accountants when applying the principles. This is because accounting principles apply only to material items. An item is considered material if its omission misstatement could influence economic decisions. Just for example, during the year, the business bought a trash bin amounting to 80 pesos. You expect to use this over several years. However, because you deem the cost as immaterial, you will record this as an expense rather than an asset. Accounting principles do not specify a certain amount that is considered material. This is a matter of professional judgment and depends on the facts and circumstances surrounding the entity. Next is the cost benefit. The costs of processing and communicating information should not exceed the benefits to be derived from the information's use. Moreover, when you prepared the financial statements, you decided to include the cost of the trash bin in a miscellaneous expenses account, together with other immaterial expenses. You don't expect users of the financial statements to benefit from reporting the immaterial cost separately, do you? Lastly, the consistency concept. It requires a business to apply accounting policies consistently and present information consistently from one period to another. Of judgmental trade-offs. This concept requires a business to apply accounting policies consistently and present information consistently from one period to another. This means that like transactions must be accounted for in like manner. For example, you then adopted an accounting policy of expensing outright all acquisitions of equipment costing 5,000 pesos and below. You will apply this policy consistently in future periods. Accounting policies used this year shall be the same accounting policies used last year. This, however, does not mean that a business cannot change its accounting policies. Accounting policies can be changed if it is required by a standard or the change would result in more relevant and more reliable information. Any change in accounting policy must be disclosed. Accounting concepts and principles refer to the fundamental guidelines and standards that govern the preparation and presentation of financial statements. These concepts and principles provide a framework for recording, analyzing, and reporting financial information consistently and reliably. They help ensure that financial statements accurately reflect the financial position and performance of an organization, enabling users to make informed decisions. Remember that Understanding and adhering to these accounting concepts and principles is essential for maintaining the integrity and reliability of financial reporting, which is crucial for stakeholders' trust and decision-making processes.
That was information overload. I will never forget that.